Happy 92nd birthday to Warren Buffett. So, on his birthday, let's talk about some of the things that have made Buffett successful and why you are not Warren Buffett and I'm not Warren Buffett. Warren Buffett is worth $100 billion for starters. He started investing a long, long time ago. I've got a book on my shelf that has all of his annual letters since 1959 that I have read and refer to often to dissect what he does to be successful, to be the world's greatest investor. One of the things he gives advice to investors is to buy index funds, which is kind of funny because he made his fortune by picking companies, by investing stocks. He spends his entire day reading annual reports, which to me sounds fun. I do some of that. But to most people sounds like a super boring job. I think if most people really understood how boring his job was, they would not want his job. He comes in the morning, sits down to a stack of annual reports and reads through them and reads through financial statements and runs models. That's all he does is read about what different companies are doing. And he is able to pick stocks that do well, and he has been able to outperform the market year over year. I think his annual returns are in the high 20s, and the annual return on average for the stock market is about a 10 and a half. So he has by far been able to outperform the market. So how common is that? Can people be like Warren Buffett? So about 15 years ago, he made a bet with a hedge fund manager. He bet the hedge fund manager that with all of his experience managing money, the hedge fund manager, that hedge fund manager could not beat the market, could not outperform the benchmark or the index fund. They bet $1 million. The hedge fund manager thought that he could do it. And the time period was 10 years. So over that 10-year period, the hedge fund manager, with all of his analysts and his resources and his knowledge and education and Wall Street behind him, tried to beat the market. At the end of 10 years, they tallied up who won, and Warren Buffett won. The hedge fund manager did not beat the market. Warren Buffett won the $1 million bet. So why did the hedge fund manager not beat the market? Well, there are a few reasons why. In 2020, 80% of the funds did not beat the market, which means only 20% actually beat the market, because it is very difficult to beat the market. Over a 15-year period, 95% of funds do not beat the market. Only 5% beat the market. Now, from an investment standpoint, the difficulty is you never know which fund is going to do well from year to year. One fund could be up one year and it could be the best performing fund that year, and the next year could be one of the worst. And that depends on how the economy does and which sector of the economy does well that year. Last year and the year before, tech has been really hot, and now tech is way down. The NASDAQ is down. The high was almost 30% this year. It's bounced back up a little bit, but it was down 30%. Well, oil and gas has been up this year. So if you have a fund that is heavy on oil and gas, it's going to have a great year. If you have a fund that is heavy on tech, it's not going to have a great year. And that changes every year. Every year, the number one sector is always changing, and the number one fund is always changing. If you look at the charts, what does well one year does poorly the next year, and it changes between sectors, between funds. Gold could be up, stocks could be down. Real estate up. Right now, everything is down, so it's not a real fair comparison. But over a year, over the long term, you see that it's always changing, which makes it so hard to beat the market, and why most people, the vast majority of people, cannot beat the market. It gets even worse when you look at day traders in real estate or in investment movies about Wall Street, which I love. I watched a little bit of The Wolf of Wall Street last night, actually. They glamorize the trading aspect of investment. They always show the trading floor, and people are yelling at each other, and they're on their phones. They're talking to people, and the brokers are putting in the trades. What the reality is that the people that make money in investments in the stock market, it's really boring. Like I mentioned, Warren Buffett's job is just reading all day. It's not the exciting making trades and doing all that every day. It's boring. The exciting part, the exciting thing about investing stocks is not necessarily profitable. What they show you in the movies is not profitable. People that are doing that are generally not profitable. It takes a lot of time. People get burned out working like on the Chicago Board of Exchange. I had a friend that did that for a few years. He said it was terrible. It was so stressful. People that day trade, not only is it time consuming and very stressful, most people don't make money. If you look at people who day trade crypto, it's even worse. I like crypto. I'm invested in crypto. But if you're a crypto trader, it's very volatile, very stressful, and the majority of people that trade, that are always in and out of trades, do not make money. So take some heed to Warren Buffett's advice, where he says to invest in index funds. A couple more advantages of index funds is the fees for an index fund are much lower. If you're trading, you're paying fees all of the time for every trade. If you're investing in a mutual fund, the average fee that you're charged for a mutual fund is 0.62%. An index fund, the average is 0.12. I'm in a couple of index funds where the fee is actually 0.04. It's practically nothing. But if we just take the averages, you see that a mutual fund starts the year about a 0.5% behind. That has to be made up just to get to the average, just to get to the market return. It has to earn an extra 0.5%, which can be substantial, especially in a down market. So index funds are cheaper. They're less time intensive for an investor, where you can just invest, buy it, dollar cost average, and not worry about it. You don't have to spend all your time reading annual reports like Warren Buffett does every day. They're cost effective, and they are more diversified because you're buying the entire market. Whereas if you're trying to pick stocks, you need a statistically significant sample size of 30 or more to really have a diversified portfolio, unless your strategy is just to go concentrated in one area, which is more risky and may take more time. So just buying index fund is the easiest, cheapest, statistically most beneficial way to invest. And if it's good enough for Warren Buffett, the most successful investor of all time and one of the richest men in the world, from investors, to invest in an index fund, then it might be good enough for us. So what do you think? Do you agree with that? Do you invest in index funds, mutual funds? Do you pick your own stocks? Do you stay out of top stocks entirely? Let me know in the comments. Also in the comments, I put a link to our website. We have a financial newsletter that goes out once a week, and a Discord where we discuss and share data on what's working and what's not working. So check out those links, and we'd love to have you in the community.